what we've been seeing in the markets and the repercussions of that, which will be seen across the board as we open up for trade this morning for us as well. Asian equities are witnessing sharp cuts as the rout in the U.S. market spills over. Remember, the S&P posted its sharpest single-day drop since February. Seth Freeman, Senior Managing Director at GlassRatner Advisory and Capital Group, is joining us right now on the show. Seth, thanks very much for taking out the time. I mean, so far, everything was looking pretty on track in the U.S. I mean, there was the economy boom, there was low inflation, low unemployment, but the sudden risk of high interest rates is causing a little bit of a frenzy in the market.
It sure is, and rates rose pretty abruptly. If you remember, just a few weeks ago, we were talking about the flattening of the yield curve and what that might look like. And just in the last few weeks, we've seen a significant increase in the 10-year treasuries.
Do you think this is a larger concern right now? Because up until now, with the U.S. markets making record highs, you think now they need to start factoring in the risks regarding high interest rates?
Well, I think what's happening is essentially from an allocation and product standpoint, debt is looking more attractive again compared to equities. And so we see greater allocations. And we are seeing, inflation in the United States. We are not seeing wage inflation, frankly, taking hold broadly. But of course, the overhang of higher oil prices is inherently inflationary all over the world. So I think it's the confluence of these things. It was interesting. I was looking earlier about, what stocks really held up today, and low-cost kind of companies, Dollar Tree or Dollar Store, a generic pharma company, Campbell's Soup, a large discount retailer. So that's not very positive, frankly.
What did you make of the IMF's global growth projections that they have made? We are seeing the impact of the U.S.-China trade war bearing down on the export numbers for China already. But, the manufacturing numbers coming out from China also seem to be a little bit more disappointing. Does that raise a question mark in terms of the global growth projections as well?
Well, I think we're starting to see some hints of the effect of the so-called trade wars, where, initially, in terms of U.S. exports, they were front-loaded, and there were quite a bit of Chinese imports that were front-loaded in anticipation of higher tariffs. And so I think we're starting to see some of that. The Chinese economy has, been doing fairly well, but there's tremendous pressure on the RMB.
Do you feel the emerging markets right now are extremely precariously placed in terms of the structure of the market itself? We've been seeing a complete sell-off since the start, at least for India, over the last 10 to 15 trading sessions. This month has been particularly bad. But the rest of Asia seems to have been witnessing pain for quite some time now. Do you see a further aggravation of this pain?
Well, there's really three kinds of investors, and there's been so much money locked into index-based funds, so that Asia-themed funds with allocations across different Asian countries, or even more broadly emerging markets, when there's redemptions or sell-offs, particularly in ETFs, it cuts across all the countries in that index. So it's not so much country macro specific as much as it's related to the indices and the percentage allocations of those countries. So I think we're seeing some of that. And of course, all of these economies are negatively affected by higher oil prices, and they've gone up relatively quickly as well.
Is there any immediate concern or a threat right now to the kind of performance that we've been seeing out of the U.S. equity markets, aside from what we've been seeing in the bond deals? Because liquidity at this point, has been sucked out from the rest of the world and plowed back into US because of the booming economy and the safer haven tag that it has. Do you see any imminent threat right now?
It is a little early to see what consumer sentiment is going to look like. There are predictions for a very strong holiday season. And on the other hand, these kinds of market jitters can really, put off a lot of investors, can make retail investors very nervous. And then we have to remember when we see large declines like we've had today and over the last couple sessions, there are triggers that certain investors have. And so we have sort of automated selling off, which then becomes a snowball effect. And I think that's really where the risk is, where it might be more technical and mechanical than necessarily a big shift in expectations.
Right. Just one last question regarding the threat that comes about with rising crude oil prices, and where, according to you, do you see the dollar move? Does it strengthen further from here?
I think there's a strong likelihood the dollar will continue strengthening, and certainly as you're seeing in India, the high oil prices are just a terrible overhang, and oil is priced in dollars. And that's going to put that much more pressure on the rupee.